Welcome to Delphos Insights. This is episode 28, where we examine future of capital raising in emerging markets in 2026. What issuers must do differently to attract capital? In today's capital environment, accessing capital in emerging markets requires more than a compelling investment story. Capital providers now demand disciplined structuring, transparent governance, and clear risk pricing. Issuers must adapt to a more complex and fragmented funding landscape where institutional investors and development finance institutions prioritize bankable, well-structured opportunities.
Right.
So to really frame the mission of this deep dive for you, assuming you are an institutional investor or a chief financial officer, maybe a private equity leader.
Or a sovereign wealth fund manager,
Yes.
or even representing a development finance institution.
Exactly. For you, the issuers and the allocators, the fundamental mission today is to dissect exactly how capital raising has changed. It fundamentally depends on, well, institutional grade structuring now.
Yes, and absolute governance discipline. Our analysis at Delphos indicates that strict alignment with evolving capital provider priorities is simply non-negotiable at this point.
Right. It's not just about a compelling narrative anymore.
No, not at all. The liquidity to fund development is still there, but the architectural requirements to actually access it have completely transformed.
Which brings us to the macroeconomic baseline. If we look at the evolving landscape, global growth is projected around 3.1%.
With very strong domestic demand in emerging markets, I should add.
Right. The demand is there. But we are seeing this massive structural pivot away from sovereign-led financing. It's moving toward private capital and private assets.
Because the sovereigns are tapped out.
Exactly. And the catalyst there is that global debt levels have reached approximately 251 trillion US dollars, which severely constrains public sector borrowing capacity.
So, okay, let's unpack this.
Please do. If we look at it from an institutional standpoint, shifting away from sovereign balance sheets is, it's akin to moving from a centralized power grid to a system of decentralized independent power sources.
That is a very apt analogy.
Right. The risk is now entirely distributed to the individual assets rather than being absorbed by the central government.
Precisely. Because with global debt at 251 trillion US dollars, governments simply lack the fiscal space to absorb those macro risks. So this forces the rise of local currency financing.
Because mitigating US dollar currency risk is now paramount.
It's an absolute necessity. If your project generates revenue in a local currency but your debt is in US dollars, you're entirely exposed. Issuers must manage their foreign exchange exposure.
And they do that within the 111 trillion US dollar FX derivatives market.
Exactly. They have to actively price in that risk. They use instruments like cross-currency swaps to transfer that volatility to a financial institution.
But of course, that comes with a premium.
Right. And the sophisticated issuer models that premium directly into their internal rate of return. If you don't map that out, institutional allocators will just walk away.
Which makes sense. So because sovereign debt is constrained and FX risk is rising, capital has to flow through entirely new private channels.
It has to. Private capital is dominating right now.
Yeah, private credit alone now exceeds 2.2 trillion US dollars in assets under management.
Bypassing traditional syndicated bank lending almost entirely in some sectors.
Right. And alongside that, we are seeing structural innovations, specifically the emergence of new liquidity options, continuation vehicles, and evergreen structures.
Which fundamentally alter the timeline of capital.
Right, because forcing a sale at year 5 on a major infrastructure project just destroys value.
Exactly. A continuation vehicle allows the sponsor to essentially transfer that asset into a new fund, paying out the investors who need immediate liquidity.
While letting new investors roll their capital over.
Precisely. Evergreen structures do the same thing by remaining open-ended.
So the timeline aligns with the asset's actual maturity.
Right. Now, the capital flowing through these new channels is very targeted. Capital allocators are strictly aligning with specific sectors.
Energy transition, digital infrastructure, and food security.
Those are the big three, yes.
But let me push back on one of those, particularly digital infrastructure, because right now, artificial intelligence is driving so much of this tech narrative. It's everywhere.
It is ubiquitous.
Right. But since AI is such a broad corporate talking point, how do sophisticated development finance institutions actually differentiate between, narrative hype and genuinely bankable digital infrastructure?
What's fascinating here is that DFIs look strictly for quantifiable impact and measurable outcomes. They completely ignore the empty tech narratives.
So they aren't funding the algorithms.
No, absolutely not. They finance the physical foundations, the fiber networks, the data centers. They want to know if a specific Tier 3 data center creates genuine economic resilience in its jurisdiction.
I see. So it has to be a tangible physical asset that drives stable cash flow.
Exactly. The AI narrative only matters to an institutional allocator if it translates to, say, a telecom giant signing a 20-year lease for server space.
Understood. So we know where the private capital is flowing, but obviously there are friction points.
Significant ones.
Right. I mean, foreign direct investment remains highly sensitive. Those flows are currently hovering around 1 trillion US dollars globally.
And that fragility is driven by very specific friction points. We are talking about severe geopolitical risk, intense interest rate volatility.
But sudden currency movements we touched on earlier.
Precisely.
But, simply ignoring that friction doesn't make it disappear. It just erodes investor confidence. So for issuers, how do they technically map these massive macroeconomic risks onto a micro-level capital structure?
Well, the mandate is that transparent pricing is the ultimate signal of preparation. You have to proactively price these risks transparently within the capital structure.
So hedging strategies?
Yes. Structured risk mitigation is mandatory. If you are facing interest rate volatility, you have to model out the cost of interest rate caps or swaps.
And for geopolitical risk?
You build thicker equity cushions, or you integrate political risk insurance to protect the senior lenders.
Right, which is required for clearing institutional hurdles. Because transparent risk pricing is really the prerequisite for surviving the Institutional Investment Committee.
Absolutely. The investment committee is the ultimate filter.
And there is a reality here we should clarify. Institutional investment committees and DFI credit processes, they do not reject emerging market risk.
No, if they did, they wouldn't operate in emerging markets at all.
Right. What they reject is unclear governance and mispriced exposure.
Exactly. Which is why capital stack design is so critical.
The precise structuring of senior debt, mezzanine financing, and equity to match the actual project cash flows.
Yes. And you often need credit enhancements to make that stack viable. We mentioned political risk insurance, but the other crucial tool is first loss capital.
Which is the foundation of blended finance.
It is. And the reliance on blended finance is massive now, with cumulative financing above 213 billion US dollars.
It essentially de-risks the investments to secure catalytic capital. But here's where it gets really interesting. Issuers face a major balancing act here, don't they?
In what sense?
Well, they potentially have to offer lower fees for certain tranches or cap their upside just to pull in that crucial first loss capital.
It is a trade-off, yes.
Yeah.
But you have to synthesize what those credit enhancements actually do. They fundamentally lower the overall risk profile of the entire structure.
Because the first loss capital absorbs the initial shock.
Exactly. If the project underperforms, the DFI or philanthropic entity takes the hit first. That protects the senior lenders.
Converting what would be a speculative venture into a bankable institutional-grade asset.
Precisely. It brings the overall weighted average cost of capital down.
Right. But even if you have a perfectly designed capital stack, insulated by first loss capital and interest rate swaps, it all collapses without the operational framework to actually manage it over time.
The governance layer, yes.
Right. Which brings us to the non-negotiables. Governance, returns, and impact proof. The absolute need for operational discipline cannot be overstated here.
Strong governance, strict covenants, and highly transparent reporting are mandatory.
And alongside that, you have the financial expectations. The strict requirement for competitive risk-adjusted returns.
Returns that are explicitly benchmarked to developed markets. There's no longer a discount applied just because it's an emerging market.
Understood. But parallel to the financial returns is the impact mandate.
Which is massive.
Yeah, driven by sustainable debt markets that now exceed 5.7 trillion US dollars globally.
So what does this all mean for the CFO? How do they balance financial reporting with this level of impact reporting?
If we connect this to the bigger picture, it means the boundaries of traditional finance have changed. Impact is no longer a secondary public relations benefit.
It's not just a marketing brochure anymore.
No, it must be audited and reported with the exact same rigor and frequency as financial returns, just to maintain DFI and institutional backing.
Exactly. The parity between financial and impact reporting is absolute. If you fail to verify your impact metrics, you risk breaching your debt facilities.
So we are moving from the theoretical requirements of governance and impact to the practical execution, the 2026 playbook.
Right, from readiness to execution.
And that starts with investment readiness. You need robust financial models and grueling due diligence preparation before you ever begin investor outreach.
Because the investment committees will scrutinize every single assumption.
Right. But the financial close is not the finish line. It is just the starting line for building a long-term track record.
Yeah.
You need disciplined execution and meticulous post-close performance tracking.
And to summarize why that matters, this level of professional discipline is what directly fuels the rapid, sustainable expansion of the enterprise in emerging markets.
Because it proves you can manage institutional capital responsibly.
Exactly. It secures your access to future funding rounds.
Which is the ultimate goal. So as you look at your own pipeline for 2026, does your capital structure actively price in geopolitical and currency friction? And more importantly, is your governance discipline rigorous enough to clear today's institutional investment committees? This has been Delphos Insights. Learn more at delphos.co.